Welcome to Introduction to Balance Sheets, brought to you by Kanjoh.com. Let's take another trip to the land of Kanjolia, where Joe is running his company called Kanjoh Incorporated. Kanjoh Incorporated is a major manufacturing firm. Joe is trying to raise some money for his company, and he needs to determine what is Kanjoh Incorporated worth. In order to determine this, he takes a look at the fundamental equation of accounting, specifically assets minus liabilities equals net equity. This equation, when analyzing it, will help determine how much his company is worth, and that is going to be the focus of our video today. Let's analyze each part of this equation in some depth. First, we got assets. An asset is anything that has real economic value. There are two major types of assets. There are tangible assets, which are things that you can touch and feel, things like real estate and inventory. There are also intangible assets, such as the brand of a company. So let's say that Kanjoh Incorporated has a subsidiary called Kanjoh Manufacturing. Kanjoh Manufacturing is known for putting out high quality, dependable goods. Its customers know this, and they're willing to pay a premium for it. That establishes a very positive brand, and that brand has value. It increases the profits. So that brand is an asset. Let's now move on to the second part of the equation, liabilities. A liability is basically a debt that the company owes to creditors. There are a whole bunch of different kinds of liabilities, but one example is a purchase made on credit. So let's say Kanjoh Manufacturing needs to purchase 10,000 tons of steel, but they don't have the cash on hand, so instead they decide to purchase the steel on credit. They don't outlay any cash, but they owe money to the supplier. So that is a liability. The biggest kind of liability is actually debt in the form of bonds. Companies issue bonds to finance the growth of their company, to buy more assets, to increase their profitability. And that is a very large part of companies' liabilities. So now we understand assets and liabilities. Let's put them together to get an understanding of equity. As I said earlier, equity is just the difference between assets and liabilities. Equity is measured in shares of the company. So when you hear about a shareholder or a stockholder of the company, they're basically buying a stake, a percentage of the equity interests, the difference between the assets and the liabilities. The last thing that you should know about equity is that it is directly tied to the profitability of the firm. Profitable companies can grow their assets faster than they can grow their liabilities. This is a little bit of an advanced concept. I'll talk about it more in depth in a future video, but what you should remember, what you should take away, is that if you can grow your assets faster than your liabilities, you're profitable. That's a good thing. That will raise the equity of a company. So let's tie this all together by looking at the balance sheet for Kanjoh Incorporated. Kanjoh Incorporated has $300 million in assets. It has $200 million in liabilities. So the difference between the assets and liabilities is $100 million in equity. It's really this simple. And I think that if you start looking at both your personal life in this context, in terms of the things that you own and the things that you owe, you can start getting a better understanding of equity and profitability in your own life and in your corporate life. Hope this video has helped you understand the issues of the balance sheet. For similar videos, I recommend you check out my website, www.kanjoh.com.